The market is currently closed for the weekend as of Saturday, August 8, 2026. At the final closing bell on Friday, August 7, 2026, Tilray Brands traded at $4.44 per share, reflecting a minor pullback of $0.01 or 0.22% during the core trading session, after touching an intraday high of $4.62 and a low of $4.44 on a trading volume of roughly 3.48 million shares. If you glance purely at the surface ticker, you might assume this stock is just another languishing penny-level cannabis play, trapped in regulatory purgatory. But beneath that headline price lies a dramatic structural shift that most casual observers are completely missing. While retail traders are waiting around for federal rescheduling updates out of Washington, management has quietly pulled off one of the most aggressive corporate pivots in recent market history. They have built an extensive craft beer, beverage, and wellness ecosystem that effectively decoupled the enterprise from pure-play Canadian cannabis risk, transforming a volatile meme favorite into a consumer packaged goods operator, generating nearly $1 billion in annual revenue. The collective expectation surrounding the cannabis sector has always been simple, almost dogmatic. Investors believed that survival required clinging strictly to cultivation, praying for United States federal legalization, and burning through balance sheet capital until the legal floodgates opened. The reality, however, is that while purists waited for legislation that never arrived, this company recognized that cash flow survival required an immediate exit from single-category exposure. By vacuuming up craft brewery assets across North America, establishing distribution networks through traditional retail channels, and building a diversified beverage portfolio, they created an operational buffer that pays the bills while the rest of the sector dilutes shareholders just to keep the lights on. Look closely at the recent price movement to see how institutional capital is digesting this transition. Over the past few trading sessions, volume on major exchanges has shown a distinct pattern of quiet accumulation during market pullbacks. When the broader market experiences volatility, retail traders frequently offload speculative shares via their Robinhood app or SoFi Invest account, driving short-term dips toward the lower boundary of the 52-week range. Yet block order data captured on advanced interfaces like the Interactive Brokers platform reveals institutional algorithms picking up those shares in the $4 zone. This isn't aggressive breakout buying, it is systematic position building by funds recognizing that the market is pricing the equity like a failing cannabis farmer rather than a growing beverage enterprise. When you examine how retail traders manage these positions across platforms like Fidelity Investments or SoFi Invest, a clear split emerges. Beginners using basic mobile trading tools often panic during prolonged consolidation phases, rotating capital into high-beta tech plays like Tesla stock or Nvidia stock in pursuit of immediate gratification. Meanwhile, seasoned investors who utilize comprehensive brokerage research or automated strategies through Schwab Intelligent Portfolios notice something different. The enterprise value metrics are starting to diverge sharply from historical norms. The core driver of recent price volatility traces directly back to the latest full-year earnings report, where total revenue climbed 11% to cross $915 million, accompanied by an adjusted EBITDA expansion to over $60 million. On the headline release, algorithms initially sold the stock down because the reported net income reflected accounting adjustments and paper write-downs. However, active traders operating on an individual brokerage or executing fractional share strategies through Robinhood stock trading soon realized the cash flow story was vastly improved. The company ended the period with over $200 million in liquidity and net debt reduced to virtually negligible levels, a balance sheet strength that is almost non-existent among its peer group. To understand why this financial foundation matters, you have to look at what the business actually does today versus what it did 5 years ago. Originally established as a pioneer in Canadian medical and adult-use cannabis, the corporate entity expanded rapidly through mergers, notably joining forces with Aphria to form a massive cultivation footprint. But as wholesale cannabis prices collapsed under oversupply and heavy Canadian excise taxation, relying solely on flower and vape products became a losing proposition. Recognizing this trap, management executed a deliberate pivot toward consumer packaged goods and craft beverages. They acquired iconic craft beer brands, wellness product lines, and distribution networks across North America. Today, a massive portion of overall revenue stems from craft beverages, spirits, and hemp-derived consumer goods sold through standard grocery, liquor, and convenience retail networks. They operate a dual-engined machine, a consumer beverage business generating steady cash flow in traditional distribution channels, alongside a global medical and adult-use cannabis segment poised to capture massive market share the instant legal frameworks evolve in Europe or the United States. This dual structure creates a fascinating tension for anyone engaging in self-investing or managing a self-directed IRA. If you search through investing sites or consult a Fidelity wealth management advisor, the traditional valuation models often struggle to categorize the company. Is it an unprofitable agricultural stock, a speculative biotech play, or a mid-tier beverage conglomerate? Because traditional Wall Street equity models struggle with hybrid business models, the stock gets priced at a severe discount relative to its actual sales footprint. Consider the macroeconomic backdrop. Higher interest rates and tight capital markets have crushed small-cap growth equities across the board, making capital raising brutally expensive for distressed operators. Unprofitable competitors who rely on continuous share issuance to fund operations are facing severe equity dilution or outright restructuring. In contrast, an enterprise that generates organic cash flow through beverage sales can fund its operational expansion without constantly issuing fresh stock at depressed valuations. This brings us back to the market dynamic playing out on daily charts. Notice how every time the stock approaches multi-year lows, trading volume spikes dramatically. Retail traders tracking the ticker on their Robinhood app or checking updates on SoFi Active Investing often interpret these sharp down days as a sign of impending distress. But order flow analysis tells a very different story. Quantitative trading desks and specialized funds utilizing interactive brokers account tools take advantage of retail capitulation to absorb liquidity. They aren't buying because they expect federal rescheduling to pass tomorrow. They're buying because the replacement cost of the craft beverage distribution network alone rivals the total market capitalization of the entire company. Comment below how many shares of Tilray Brands you currently hold in your portfolio and whether you are holding for the beverage growth or the cannabis upside. Looking ahead, the road forward is defined by a series of high-stakes catalysts that will test the market's expectation against reality. The consensus Wall Street narrative assumes that without dramatic legislative changes in Washington, the stock is doomed to range-bound trading. But this expectation ignores three key operational reality levers. First, the continued integration and margin expansion of acquired craft beverage brands provides a clear runway toward sustained net profitability. As operational synergies take hold across production facilities and logistics routes, gross margins in the beverage division are projected to climb, providing consistent cash flow. Second, international medical expansion offers an immediate growth vector that does not depend on United States federal action. Changes in European regulatory frameworks, particularly in major markets like Germany, have opened significant channels for prescription-based medical distribution, where margins are substantially higher than in competitive North American adult use markets. Third, if United States federal policy eventually shifts regarding banking access or scheduling, the existing craft beverage distribution network provides an immediate, ready-made logistics network to roll out hemp and cannabis-infused products nationwide overnight. For individual investors utilizing Robinhood Cash Management, exploring options via Fidelity Brokerage, or evaluating growth assets through SoFi ETFs, the primary risk remains execution and regulatory delays. If beverage margins compress due to supply chain inflation, or if European medical expansion slows down, the market will retest historical support levels. However, if management continues to execute on debt reduction and cash generation while expanding its distribution footprint, the valuation gap between present trading prices and total enterprise revenues will inevitably close. The contrast between expectation and reality in this stock could not be starker. Expectation views the equity as a speculative, cash-burning cannabis play tied entirely to political headlines in Washington. Reality shows a streamlined, multi-category consumer beverage and wellness business with near $1 billion